Next is the accounts receivable turnover ratio. This looks at a company's effectiveness in collecting the money customers owe. It measures how well a company uses and manages the credit it gives customers and how quickly that short-term debt is collected or is paid. To calculate this ratio, you add the value of accounts receivable at the beginning of the specified period to the value at the end of the period. Then divide the sum by 2. For example, Yolanda's Yogurt had the following financial result for the year. If we want to calculate the AR turnover ratio, we add the two accounts receivable amounts and divide by 2 to get the average AR amount. In this case, it's $6,000. Then, divide the net credit sales by the average AR. This gives you the AR turnover ratio. A company that is on top of collecting payments due will have a higher accounts receivable turnover ratio. Let's hear more about these two ratios from an expert.
So accounts receivable and accounts payable turnover are probably something that you can almost kind of guess at what they are to a certain extent. Accounts payable turnover is how quickly you're paying your bills. A business is paying its bills. And obviously that one, the vendors especially want to make sure that that's as low as possible. We want to make sure that the bills are getting paid on time. However, of course, a business might need to conserve its cash, and so it stretches that a little bit. So that balancing act between stretching out how long you can pay till you have to pay a vendor and them wanting it to be really short, that's kind of the balancing act that you have there, and measuring that AP turnover can be helpful. What I see more often is that a business that has credit extended to their customers where they have accounts receivable, that's the one that, of course, the business owner is going to want to make sure that they have a little bit more understanding of. And that is that they don't want it to be too low. We don't want to have our clients constantly stretching out how long they pay. And so a low turnover ratio is not going to be good for the client, the business, because they would be not getting paid. So they have recorded a sale, but they don't have the cash in the bank. And so that can be an issue. And so we need to make sure that that is something that they realize. But a high turnover ratio usually would be a good sign, meaning that they are going to have, first of all, maybe more cash sales, or they're collecting their receivables very quickly. But some people would say that it means that you're not extending credit to certain customers that you may want to have, things like that. So there's a lot of different ways to look at this, and it really does depend so much on the business. Many professional services companies will have no real receivables. And quite honestly, a lot of times accounting systems now can integrate with payment processing so that they start looking at using credit card and debit card transactions. And even though they might have to pay a small fee, it might help with their AR turnover and help with their cash flow so much that that fee is minimal compared to what it would be if they had more of a collections issue. And so you're going to see that affecting both of these ratios. And so as the bookkeeper highlighting this, but then also highlighting a solution like a payment processor might be a way to go to really provide a value to that client as you're explaining these, letting them know about it, but then also perhaps finding solutions that can help make those issues disappear for them.